When a project is to be analyzed, there can be two major scopes of analysis in that situation. One is the financial level of analysis and the other is economic level of analysis. As the words explain to us that in the financial analysis, we'll be talking about a limited scope, the financial matters of the project. It is more of an accountant's approach to analysis, who is mainly concerned about the debits and credits. Whereas in economic analysis, we can also talk about the externalities and the effects on the economy of that certain project. So definitely the economic analysis is likely to be a greater sort of scope as compared to the financial analysis. Now we can talk about the comparison of these two levels of analysis in the light of various points. Let us talk about the very first thing, and this is about the nature of the costs and benefits that are included in the financial analysis. As you remember, in the financial analysis, the approach is limited to the project itself. If a project is treated as a firm, then the benefits and the costs to that firm are limited to what is received and what is paid from the project. And that is why the direct benefits and the direct costs are only included, because these are the costs and benefits that are directly related with the objectives of the project. But when it comes to the economic analysis, both direct as well as the indirect costs and benefits, they are included. Because our level of analysis, our scope of analysis is now broader, and we are trying to internalize all the effects. They can be either benefits or they can be costs, but the scope of analysis is now broader, and it is just not limited to the boundaries of the project. We can also include the indirect costs and benefits that are including the effects of the project on the overall economy. So this is the difference. Again, the comparison is holding true for this greater sign, because we will be including the indirect benefits and costs as well. So the scope of analysis will be greater in the economic analysis. Now let's compare the two types of analyses in the light of transfer payments. The transfer payments, they are composed of taxes and subsidies. Now they are treated as direct costs and direct benefits, depending upon if it is a tax or a subsidy in the financial analysis. Whereas the taxes and subsidies, they are not included in our economic analysis. For this, we should come to this sketch. This sketch will enable us to better understand this thing. Let us assume that we are talking about an economy, and this is that economy, and this is the project that we are talking about. So you can see this project is representing the financial analysis, and the whole thing is representing the economic analysis, because we are including the B's and C's, that is the benefits and the costs, that are affecting the overall economy, that are spilling over from the project to the overall economy. So the taxes and subsidies are basically mere change of hands. For example, if the state imposes a tax on an entity or an individual. For example, on this individual there is imposition of tax. This will be redistributed in the form of expenditure on other masses or other people or individuals who are relatively less privileged, and they are relatively, financially speaking, poor. So you see, the you know the resources, they are getting redistributed here. And in this case, if a subsidy comes to the project, it is an addition to the project, and if a tax is paid by the project, it is a subtraction. So from the financial point of view, this is something to be addressed. This is why in financial analysis we include the transfer payments, that is taxes and subsidies. Whereas when it comes to the economic analysis, the transfer payments, that is taxes, and the subsidies are mere change of hands, because the amount remains in the overall economy and it is just mere change of hands. So the overall impact on the economy is nullified. From one entity or from one group of people it is subtracted, and to other people it is added, or other group of people or an individual, to their resources it is added. So the overall effect is nullified, is cancelled out. Therefore, in economic analysis we do not talk about these transfer payments and we avoid including them. This is what you can see. We have mentioned here the mere change of hands, and here there is a change in the financial resources depending upon if it is a tax or a subsidy. So now let's talk about another similar situation. We can come to point number 3 at the end, because point number 4 and 5, they are similar to point number 2. So we are changing the order just for the sake of better understanding. And the point 4 is about borrowing from the local resources. One can borrow from the local banks. In every country we have financial institutions. They are banks and non-banks. So if the borrowing is done by the project from the local sources, then the analysis includes those payments or those receipts, because they are bringing a change in the overall financial situation of the project. For example, we have done the borrowing from a local financial institution. So this is an increase in the resources of the project. So we include it in our financial analysis. Whereas if we talk about the economic analysis, this thing again is a mere change of hands from one party in the economy to another party in the same economy. So it is justified not to include it in our financial analysis, in our economic analysis. Whereas in our financial analysis we include it because it makes sense to include those increases in the financial resources that are a result of the local borrowing. Now let us talk about another possibility of a similar kind, that we are borrowing from international financial institutions. When we borrow from international financial institutions or any other country, it is an increase in the financial resources of the project, and there is no concern of the geographic jurisdiction of the source, because if from the financial point of view, this is no concern if there is an increase in the economy or there is a decrease in the economy in terms of financial resources. So we can include these transactions in our financial analysis, just like an accountant. Whereas when we borrow from the international sources, the concern is greater because there is a borrowing economy and there is a lending economy. So there is an increase in the economy because the resources are coming into the borrowing economy from the lending economy. So this should be included in our economic analysis. Let us try to visualize it here, that if this project is receiving some financial resources in the form of loan from an international financial institution, in this case there is an addition in the resources of the project and it should be included in our financial analysis, as we just saw in the last point. But at the same time, this is that point where there is an addition in the overall economy, because this is some other financial institution. So this is the boundary of the borrowing economy and some resources are entering here into this economy. So the economic impact is there and it is justified to include this transaction in our economic analysis, because there is an economic impact as there is some resources flowing in from the lending economy or the financial institution in some other economy or any other international financial institution into the borrowing economy. Therefore, we address this thing in our analysis, that is the economic analysis, and this entry is conducted. So in this way, these 4 points have been understood, that how we address the financial and economic analysis and what are the key differences. So the fifth one is yet to be addressed, which is at the serial number 3, and in this analysis and in this aspect of the analysis, we use the market prices when it comes to the financial analysis. Market prices are simply the prices that we observe in the market, and the goods and services are bought and sold at this price or at this set of the prices. For example, if we talk about the price of land and if we want to consider the market price, it will be the price of the land that is being used to buy and sell various pieces of land. So it is something which is visible in the market and people are well aware of it. However, when it comes to the analysis of the prices in economic analysis, we use some other prices. For instance, if an individual is living in a place since his childhood, and due to a certain project, if that place is to be dismantled or taken by the state to build something else over there, for example any bus rapid transit, in that case definitely the state would compensate the individual whose real estate is being taken from him. But since he has been living there since childhood, there will be a certain level of affiliation of that individual with that place, which is in addition to the market price that is being quoted in the market. So this affiliation should also be compensated by, for example, paying him a certain additional amount, by compensating the individual in some monetary way. So the shadow price, which is the name of this kind of price, is actually that price in which we consider the market price. Here we are talking about the land, But we also try to include the other factors that are usually overlooked by the accounting approach. For instance, here the value of the sentimental attachment of the individual is also to be considered. And if we add it in the market price, then it is a better representative of the value that an individual places to the piece of land that he has been using or living on. So the value of land to the seller, who may value it more than the market price due to his old affiliation. And this shadow price tries to assess the true value of the resource to the person who is actually owning that resource. So again, the same thing is verified that the economic analysis is more comprehensive as compared to the financial analysis. Here we have just market prices, and here we have shadow prices that are trying to represent the thing that is available in the market, that is the market price, but these shadow prices are built on the basis of the market price. They are trying to represent the actual value. So we call them shadow prices and imputed prices as well at times. So economic analysis has this difference as well. Therefore, now we have observed at least 5 differences when it comes to the financial analysis and economic analysis, and we have noted that there is a certain degree of difference between the two kinds of analysis that we can do. But when it comes to the state level analysis of the development projects, definitely we are talking about the economic analysis and not just financial analysis. Whereas the financial analysis is included in the economic analysis, is a part of it, as we can see in this diagram as well, that financial analysis has a smaller scope but within the scope of the overall economic analysis. Moreover, the financial analysis is more desirable in the private sector. However, there is quite a bit of overlapping between the two, and we should note this fact. This is why there was a need to shed light on the two and compare them side by side in order to be able to understand the thin line between the two. So this is how we compare the financial and economic analysis, especially from the point of view of development projects. Thank you.